Hey guys, we are here for our next session with Mona El Isa. She'll be doing a talk on market making observations from the Goldman trading floor to DeFi, and I'll let her take it from here.
Hi guys. So many of you know me, I guess, from the panel we just finished, but I'll just do a quick intro and then dive into today's subject, which is market making. So for most of you that may know me already, you will probably have heard of me from the Melon protocol. Melon is an on-chain asset management protocol that we started building in 2016. It's on the Ethereum mainnet since over a year ago, and it's a completely decentralized protocol to set up and manage your own fund or investment vehicle on-chain. For maybe what is a little bit less known about my background is that I come from a market making background. I spent almost a decade of my career working on the Goldman market making desk from 2003 to 2011. So I've basically spent most of my career making markets. I've made markets in large cap stocks and very small cap stocks, and also pre, during, and after 2008. Also, equities, for those of you who don't know, well, for everyone, as everyone knows, sorry, is not a 24/7 market, 24/7-hour market. Therefore, there is not liquidity in it all the time, and we've also had to make markets when the markets are closed, because that's the job of a market maker. So I think market making is something I understand. And today I want to try and use that experience to make some observations about market making in DeFi, because I feel that there's sometimes a little bit of lack of understanding around what a market maker is really meant to do. I think I understand this space. So in this talk, I'm going to try and explain some areas where I think DeFi lacks in market making. So I'm just going to toggle my video right now so that you can see my slides. And let's go. So basically in this presentation, we're going to try and cover three main subjects. So the first is that liquidity on DEXs, as far as I'm concerned right now, is a failure right now. And that is because, in my opinion, there are simply just not enough market makers. So that's the first big point I want to make. And now I also want to emphasize, we'll go into this in more detail, is that by market makers, I do not mean arbitrageurs. Arbitrageurs are people who just make money without taking any risk. And a very important characteristic of a market maker is that they take risk in order to absorb liquidity. The second really big point I want to make is that I'm hopefully going to share some concrete ideas with you guys on how market making in DeFi could be improved. And obviously, if market making methods are improved, then I believe that we can enhance DEX liquidity. And the third thing I'm going to talk about is basically trying to explain or attempt to explain why market making has failed so far in DeFi. So with that, before we even begin, I just want to make sure we're all on the same page about what liquidity is. So for me, liquidity is, for any given asset, an inverse function of size. So regardless of the asset, there's always a size at which point trading becomes illiquid. So if I were to ask you guys, is Ether liquid? What would you guys respond? Any answers? Is the ETH USD pair liquid? Right. The answer is that it actually depends. If a sovereign wealth fund comes along and asks you for an offer in 11 million ETH against USD, you're looking at a $2.4 billion trade, and you're looking at trying to price 10% of overall supply. So if you were thinking, when I asked the question, that yes, liquid, Ether is liquid, the answer is actually, it depends. we've just proven, or we've just seen a situation where someone wants $2.4 billion of liquidity, and there is definitely not $2.4 billion worth of liquidity on the order book, at least at any reasonable price that would be traded at. So this is where a market maker would have to step in and say, look, I'll make this price. I'm going to offer you $2.4 billion of ETH against USD at this price, and I will inherit all the risks. And basically, that's the creation of liquidity. If that price results in a trade, you have created liquidity. So this is a little bit of an extreme example, but I wanted to show such an extreme example so that we can make sure we're all on the same page. So regardless of the asset, there's always a point at which an asset becomes illiquid because of the size. So what is market making? Market making is the creation of liquidity in illiquid situations. So by definition, if your price or volume as a market maker is worse than what you would find on an order book, I've got news for you. Basically, you're not a market maker, because you could have gotten the same order, maybe even better execution on an order book. So over here, I've got a graph, or a little table, sorry, that shows you why I think, or kind of tries to show the point that market making is failing on DEXs, and this is why. I've shown Kraken here. Obviously, it's not DeFi and it's not a DEX, and it's not a perfect comparison because there's no USDC pair on Kraken. But I showed it here because a market maker is always supposed to have better liquidity than an order book. So I just put it in there for illustration purposes. Yesterday, I, for fun, just went into a bunch of DEXs or DEX aggregators. And I also went into the Kraken order book, and I tried to see where I would be able to buy 25,000 ETH. So on Kraken, I would have had a slippage rate of less than 25% if I wanted to accumulate 25,000 ETH. On Uniswap, my slippage would have been 65.5%. Uniswap obviously being an automated market maker. On 1inch, which is an aggregator of market makers, and I think also order books, the slippage would have been 59%, on DexAG 37%, and on Paraswap 63%. So the point I'm trying to make here is that if you can get better liquidity on an order book, you don't need a market maker. The market maker is actually supposed to solve the order book lack of liquidity, right? So how do we create liquidity? The whole point of a market maker is to be that person that steps in and provide the liquidity when liquidity cannot be found. As we talked about before, that involves taking risk. It is not the same as arbitraging. Prices made by market makers should result in trading because they're rational prices and fair pricing. So making a price, but making it so wide that somebody wouldn't rationally trade at it, is not really creating liquidity. And by definition, either the price or the volume of a market maker should be better than what you can find on an order book, and usually both. So how do we create liquidity in something that is not liquid? That's a really good question, and I'm going to try and argue that it's not easy to do in an automated way. In fact, it's close to impossible, because there's a lot of information that should go into making a market. I'm going to list a few of the things here. So the first thing I would list is volatility. So this isn't an exact science, but in general, before you make a price in anything, you really should understand the volatility, the historical volatility, and therefore the implied volatility in the underlying asset, because that will give you a feeling for the sort of types of swings you can see in this asset, with some kind of idea around probabilities, right? And I say it's not an exact science because it's not. It's something you've got to take into consideration with many other factors. And if you only price things based on volatility, you'd be pricing very wide. But in general, you have to price much more competitively than that if you want to result in a trade. So I would consider it a little bit of a soft factor because it's not exact science. The second factor that goes into market making is liquidity. Now, when I talk about liquidity, I'm not talking about liquidity that it can be found in one asset pool, right? Like, or in one market making pool. I'm talking about the liquidity that you can find everywhere and anywhere, right? So whether that's centralized exchange or DEX exchanges or people you know or large holders of the token or people who have been buying the token recently or people who have been selling the token recently, that's what I mean by liquidity, the full picture, not just what you see on an order book or from one provider. And the job of the market maker is to have the full picture of liquidity and to be able to source it. And if you can't source it, the job of the market maker is actually to put up his own capital or her own capital in order to provide that liquidity. So again, because of the relationships involved in knowing who owns what and who's been trading what, I would say this isn't something you can always hard code, but it does involve relationships and knowing people, or at least having an idea of who's been trading what. And I would consider it a soft factor. The third thing that goes into making a price or market making is your market share in the underlying asset and your ability to influence your market share. So what do I mean by that? If you have been trading most of the overall volume in an underlying asset for the last 2 weeks, the likelihood is you have a large amount of information on that underlying asset, information that most people wouldn't have. And because you have that information, you're in a better position to know more about that underlying asset than anyone else. And so this is something that can also go into your market making. And when you make a price, this can be really important. Again, this involves knowing people and having relationships. So again, notice that it is a soft factor that is not easy to hard code into a smart contract. The fourth factor that goes into making a market is news surrounding the underlying asset and any upcoming catalysts. If you're going to be in a position where you're providing liquidity and taking inherent risks or inheriting risks as a result of providing that liquidity, you better know what's just happened recently in terms of news flow and make sure you understand if there's been a big price move. And you also better make sure you know that you're on top of any factors or any news or upcoming catalysts that will be coming in future or in the short term for the duration of the time that you're going to be unwinding that risk. Because those are factors that could potentially kill you in terms of your P&L. Again, a soft factor, because you really need to understand not just the actual news, but the impact it could have and the risk it could have on a position. The fifth thing that a market maker usually takes into consideration when making a price is the hedgeability. So, as I mentioned, when you make a price, you inherit certain positions. You don't necessarily want them, but you are going to have a bunch of risks depending on the markets you make, and those risks could be very volatile. So being able to hedge them easily will determine how competitive you can be or how tight your spread can be. If there isn't an easy hedge, probably your price is going to be wider. So being able to assess quickly and efficiently what a good hedge would be and how fast it would take to put that hedge on is very important. Again, a bit more of a soft factor because there is like information and knowledge and sometimes even speaking to experts on certain assets that is needs to be obtained before you're able to judge that. And some of the very biggest prices, by the way, that market makers make can take hours to price. It's not unheard of. So it really just depends on how big a block you're pricing. The sixth factor that goes into making a market is the reputation of the trading counterparty. So, whether we like it or not, because I know this is not information we have in DeFi, there are good actors and bad actors in every market, right? And it's not unheard of that if I was making a market for a client which I knew was a bad actor because they consistently trade against me when I know they have information ahead of time, or they're using information against me, I will start to price differently for someone who continuously rips my eyes out versus someone who is upfront about information with me, and is what I would call a good actor. So reputation really matters, and will or should influence how you price to certain parties. Again, soft factor. The seventh factor I want to talk about is understanding recent behavior, price behavior, and also volume behavior. So before you make any price, again, I think we touched on this earlier, but if there's been a huge or very volatile move in the underlying asset, make sure you understand why. If you understand it, you'll feel more comfortable making the price. From my experience, if you don't understand it, don't price it such that you don't make the trade. But basically, looking out for these big moves and trying to understand them before kind of being hit or lifted or inheriting a position you don't want necessarily, can be very painful after a big move, because it could just be a misunderstanding or a false rumor, and it will bounce right back, and you'll have to deal with the consequences, and not pretty. The eighth factor I would take into consideration is your general inventory and general positioning. So we talk about inventory a lot, or I hear people talking about inventory a lot, but it's not, I guess, just the inventory in the asset pair you're trading. It's actually your overall book that you should take into account. And that will change according to other markets you're making, and trying to look at it in a more holistic way is going to be important. But also the job of a market maker, could be to anticipate market moves, right? So if you believe, because you're as a market maker, you should know the assets you market make inside out. If you know them inside out and you really understand them, you should be able to predict, when something is too low or too high, and therefore adjust your inventory accordingly in anticipation of future orders, so that you're better positioned for when the buyers come or when the sellers come in a certain asset. Again, notice how this factor is a soft factor and not one that can easily be hard-coded into a smart contract. And last but not least, like any other business, market makers have to make a business decision in terms of how they price based on who they're dealing with. You might be willing to compromise or price a trade uncompetitively because of the overall picture. Maybe this person trades with you every day, 10 times a day in huge size, and really this one time needs a good price. And on the flip side, you might decide that this person that you're pricing for is paying 1/10 of the commission rate that any of the other people you're pricing for pays, and therefore is not worth as much risk as the next guy. Again, soft factor. So there's no easy way to hard code these soft factors into an automatic market maker. And hopefully, the slide previous just illustrated that through the 9 factors that we walked through. And most of them, in fact, I think all of them have some kind of soft element in them, which will not be efficient when automated. So by definition, if we cannot hard code the factors that go into good market making, then by definition, DeFi cannot scale without manual market makers that can take some of these softer factors into consideration. So we talked about, why DEX liquidity, or I tried to show in this presentation why DEX liquidity hasn't scaled and why DEX liquidity is failing so far. I tried to give some concrete suggestions on, how we can improve liquidity, maybe less on the automated side and more on the manual market making side through taking other considerations into account when market making. And I guess the last part of the presentation, I promised to make a comment on, why are we missing this? Why haven't we figured this out yet? And I'm just going to kind of end by saying that, most of the people in DeFi and maybe even here are technologists by background. And so I can see the appeal and the excitement about building a fully autonomous, fully automated market maker, because it's really a lot cooler maybe than manual market making, especially in the eyes of a technologist. But the reality, in my opinion, is if we do want to scale liquidity, we do have to find the right balance between manual market makers and automated market makers, because in my opinion, there is no scaling without the manual market makers. So to conclude, market making is the provision of liquidity in illiquid situations. As technologists, we might be in love with the idea of automating market making, but this didn't work out in traditional finance, and it won't work out in DeFi probably. Actually, just a word on that. Automated market making has been around in traditional finance for nearly 20 years. I was involved in the creation of some of the very early automated market makers. At the time, we were all terrified that this would mean the end of our kind of careers, because what's the point of having a manual market maker if you have an automated market maker? And so we all feared we'd lose our jobs the following year. 20 years later, there's still a fully staffed market making desk on the Goldman trading floor, and every other large broker dealer on the street. So it hasn't scaled. Automatic market makers basically still deal with high touch, very liquid orders, but manual market makers are still required, even in traditional finance, to make markets in the illiquid blocks. The last point to conclude with is that, in my opinion, the only way forward is to focus on the softer factors that go into market making, which can not easily be hard coded. And that, for me, translates into manual market makers. So I think that is it from my side. I am happy to take some questions. I think there's a few. How do we provide continuous liquidity for an initial illiquid asset, i.e. a new token? Is it possible? Drew. Yes, Drew, great question. I've lost the question. Yeah, here it is. So you can provide liquidity for a new illiquid asset. It might not be continuous though, and I think that should be okay. I think automated market makers definitely solve that problem to a degree, because you can trade in small size, in a new kind of asset in an autonomous and automated way. But again, when you need the big size or the bigger tickets, you will need manual market makers to intervene, and that can happen OTC. So I'm not saying that you only need manual market makers. I'm saying that the two are very complementary if we want to scale liquidity. So I'm going to move on to the next question. Can you tell us more about the Melon protocol? What is the 5 to 10 year vision? Sure, yeah. So the Melon protocol is a completely decentralized on-chain asset management protocol. It enables anyone to customize the setup of their investment fund in a few steps. So you can predefine rules in smart contract code on Ethereum, of course, predefining things like what management fee you want to charge, what performance fee you want to charge, which asset universe you want to be able to trade with, which DEXs you want to be connected with, which investors. You can keep your fund open to anyone, or you can whitelist certain investors. You can basically customize a ton of different parameters, and we're constantly improving and increasing those. You can also do things like risk management policies. So it basically helps establish trust between investors and fund managers in a decentralized way without needing to trust any third party. So yeah, I mean, I'm happy to talk to you more about that offline. You can reach me. It's pretty easy to reach me directly on Twitter or Telegram. Okay, so another question. How can we redefine market making for the DeFi world? Your approach and conclusions are sound, but we have to think outside the box. Yeah, that's from Ellie Henry. Yeah, so that's a great question, and it's the beginning of a very interesting discussion. So I think that there are, in fact, I know there are some frameworks already for manual market makers built by, people like Kyber Network, and probably I think 0x has just come out with one this week or last week. So that's a really good start. But yeah, I think redefining completely, I'm not sure that we need to redefine it completely. I think we can just take the elements from the traditional market making world that make sense and that we can apply to DeFi and apply them. I don't think it's something that needs to be reinvented from scratch. I think the kind of innovation around DeFi is the fact that you can market make now without the need for an intermediary in terms of a financial intermediary, in terms of settlement and all of that kind of stuff. So I think that we've already got good frameworks and good infrastructure for this, but we can definitely take lessons from traditional market making and apply them to DeFi to scale liquidity. Next question, if both...
so I think we're actually out of time, okay. But this talk was fantastic. Do you mind dropping your Twitter handle into the chat so people can reach out to you afterwards?
Yeah, sure. I'll do that now. Cool.
All right, cool. Awesome. Well, we're off to our next session. Thank you so much. This was great.
Great. Pleasure to be here. See you guys.
Yep. Bye.